Good evening, everybody. A quick guide to understanding what I mean by risk on or risk off and how to determine where we are currently. So, the definition of risk on globally all around the world is if we're risk on, stock markets are going up. And because of that, the dollar and the yen will depreciate because they're safe havens and the riskier assets, such as the Australian dollar, the New Zealand dollar, the euro, and the pound, they go up because they are riskier currencies, so they'll perform well. So that's risk on. So that should be quite clear. Risk off is when stock markets go down and the dollar and the yen will go up. They'll outperform, and the Australian dollar, the New Zealand dollar, the euro, and the pound will come down, especially against the dollar and the yen. So we can think of it as you can use a fruit analogy where a fruit or vegetable, it goes off, it will sour. When it sours, you don't really want to buy it. It's you want to sell it, and that's what that means. So risk off is stock markets down, risk on is stock markets up, and there's fundamental forces in play that are pushing price for all the currencies. So it's absolutely vital you understand where we are, whether or not we're risk on or risk off, and also this will explain why the sentiment does go against us because the fundamental forces are stronger than the sentiment. So it's absolutely imperative you understand the difference, the forces enacting on the currencies. And now I'll talk about how we determine where we are. So technically, it's dead simple. We just come to a financial website, check your S&P 500, and you check on the day. And if we're green, then we're risk on. Check your 52-week range. We're bullish. We're very much risk on because we're here all the way up here. So that's how to determine technically whether or not we're risk on or off. Sentimentally, we can come to the dashboard on the spreadsheet. So I've broken it down into sort of two components. This is the snapshot, and this is the 24-hour change. So at the static level, like a snapshot, we are risk on because for every one person buying the S&P and the indices on average, over 8.8 people are trying to short it. So that's a very heavily biased sentiment and telling us that price should continue to go up because these guys are normally wrong, and it's a very crowded trade. -8 is quite bullish for us. However, what is important is to determine the change over time, and we see that we're actually moving away from being risk on over time, the 24-hour change. And if it continues to do this every day, then it's going to impact the big picture, and that number will get closer to zero. When we go into positive territory, the retail guys are net long, and once that happens, we'll see a big consequence on the stock markets because the smart money want to do the opposite. The dumb money, if the dumb money are buying on average, then things are going to be quite bearish on the S&P. Lastly, the reason for us being risk on and the fact that the retail guys are heavily net short is some propaganda technique that the mass media are doing and always have done, and we call it FUD, and it's fear, uncertainty, and doubt. And what happens, it's a strategy, tactic to influence public perception, encouraging them to sell the indices because the smart money who control the mainstream media really don't want the dumb money to buy. They want them to continue to short. And the moment they go net long, then the smart money are going to want to jump ship. And they don't want to jump ship. They want to ride this roller coaster. So hopefully that helps. So there's a little bit of psychology there, and this is the reason why we've been risk on for so long on the spreadsheet. However, the retail guys are starting to go long over time, and that's a slight worry. When I made this video in April, we were -12 and now we're -8, so we're seeing a shifting away over time. But as long as we don't go into positive territory, the big picture is that we're risk on. So that's really important that you understand that. We keep an eye on the VIX as well. Lower VIX is bullish indices, a higher VIX is bearish indices. It's a volatility measure, it's a fear gauge. So hopefully it helps. Have a good week, and I'll speak to you guys soon.